Good afternoon. This is Chris Robinson, Robinson Ag Marketing, with today's post-close grain and livestock comments for Monday the 15th, halfway through the month, kids. My letter that entitled this morning was entitled "Down $1.02 in 18 days," and that is what soybeans did. I've heard some interesting stuff where people trying to blame X, Y, Z for this and that. Um, I just think it's one of those things where uh, a lot of the rally was from speculative money. That's the reason we rallied $1.56 in a month, as November options expired. And those same people, this is the revenge of the GameStop traders, as far as I'm concerned. The same people that chase those headlines now. Um, I doubt if they're still long, I can tell you that. Now, yeah, the funds had built up a big long position, but all that information is a month old. And, we're sitting where we're sitting right now. Can I tell you? We're Jam Beans traded 1067 and a half. The high of the move earlier this year was 1069 and a half. We hit 1067. We settled at 1071 and three quarters, down five in the day. Novi Beans caught a little bit of a bid at the end, maybe a little bit of spreading there. We did hit some good technical support there at 1083 and a half, 1084. Again, the high of the move. We had an 83-cent rally in new crop beans October 1st to the November high, and we've given back about 40% of it. And again, very, very technical. I know, look, fundamental traders hate technical traders. I understand. I've been doing this for 30 years. Um, it's just one of those things. You've got to be able, I think, to look at all aspects of why the market's doing what it's doing. And, if you look at this, it's extremely technical. I'm looking at new crops right now. 1090 was halfway back of the rally. We bottomed out today, like I said, around 1083, 1084. There's a gap down there. There's more technical stuff. And I understand a lot of guys out there, their eyes glaze over. They hate it. But remember, I've been doing this since 1991. Um, and uh, the best approach that I found is the combination of fundamental and also technicals. Um, it doesn't have to be either or, but right now the technicals are driving this thing. That irritates a lot of people, I know, because I get a lot of direct messages and emails telling me how much they can't stand technical analysis. Well, I always just say it's a tool. Use it. You have a toolbox. You've got a jigsaw. You've got an axe. You've got a screwdriver. You got a Phillips head screwdriver. There are different tools for different times of the years, and that's why trading or hedging is more of an art form than a science. If it was a science, heck, it would just all be run by AI, right? There wouldn't be a market. So this is about emotions. This is about money flow. This is about weather. This is about all that other stuff. And that's why people get so angry, because it is difficult. It is not easy. And when I point out something after the fact, people say, "Well, hindsight's 2020." I'm like, "No, I understand that. You don't have to tell me. I've been doing this for a long time." That's why all I've learned is when you get really good rallies or when you get horrendous breaks, have a plan to try to take advantage of them. It really comes down to it that much. And there's no algebra problem out there. There's no Pythagorean theory into trading. There's no um, definition of you know differential calculus, which is going to say, yeah, if you give me $100, we can make $1,000,000. It just doesn't exist. So because of that, we hedge what we can when we can with what we can, right? March beans um, down a nickel and a half, down 5.5 cents, 1081 and a quarter. March corn, that's their corn in the bin at this point because Dees is history. We could not get above the 200-day moving average. Again, it's technical. I get it. The 200-day moving average is at 446 and a half, 447. Nothing gets bullish until we get above the 200-day moving average. Why? Because a lot of long-term trend following programs only do something if the 200-day moving average tells them to do it. So, and the risk is we're going to drift sideways to lower a garbage trade until the January 12th report. That's what I would predict. In the wheat, down 8.5 cents again. We just can't buy a higher settlement. We hit 519 and a half. We are closing in on retesting the contract lows. Those contract lows also happen to be 5-year lows. It's 508.5 in March, Chicago. We settled at 520. Maintain a floor, be defensive. I would not be selling physical grain down here unless I absolutely positively had to pay bills. And then if I was being forced to sell down here to pay bills, the first thing I would do would be to look to try and re-own those, especially before the USDA report on the 12th, because nobody knows what the report's going to be. I don't know if it's going to be bullish or bearish, but I know I'm going to have hedges on um, to try and cover whatever happens out of that number. That's what I'd rather do. I don't care about your opinion, what the USDA is going to say, what they're going to do, whether you believe them or not, whether they've got an ulterior motive or not. Just hedge the price. They still haven't, as far as I know, nobody's figured out how to permanently influence prices, right? Supply and demand is what wins at the end of the day. Thank God for that, because if a person or a computer program could automatically determine what the prices were going to be, I don't think we'd want to live in that world. To tell you the truth, that would be dystopian to say the least. In the meal, a little bit of a bid there. People trying to buy Jan meal against $3. Again, meal just on its heels. Um, had a big 50, almost 60% correction of its last rally. March bean oil also finished the day down 60 cents. Again, trying to fight it out there after, there was a lot of interest in there earlier in bean oil not that long ago. Go back to look at the chart in um, July, right? There was a lot of interest there. And we just sit here now at 50 cents. Why is 50 cents important? Well, it's a technical level. You take the entire rally, and I'm taking the rally, which started basically at the beginning of the year, 2025. You run it all the way up. This area right here, 50, 57, it's a 38% pullback. I'd be watching to make sure that 48.65 holds. That's probably the downside risk for bean oil. And definitely there's some pressure there. You also have crude oil drifting lower. Lower crude oil prices don't end up on the television set because nobody gets upset about that. But today's low in spot crude oil, we're under 57 bucks. We're at 56.40. If we take out the October low at 56.60, that's going to be a little bit of a headline. The number that really matters, the April low, 55.12. That's a 5-year low, sports fan. So we're we're less than $2 away from testing a 5-year low. That never gets the news. That never gets on TV. $150 barrel oil, yeah, they can't wait to light their hair on fire. But when prices go lower, they don't, there's no story there, so you don't hear about it. But it does tend to drag on the rest of the commodities as well. In the livestock, kind of a quiet day. When was the last time we had a $4 trading range in feeder cattle? I can't remember when. That's what we had today. Finished slightly higher on the day. In fat cattle had a $3 trading range. Just really kind of a breather day, and I wouldn't be surprised to see more of that as we get through the rest of the year. We did just about fill the gap in fat cattle. We came down on today's low at 228.80. The gap gets filled at 228.70. So it came right down there. Didn't quite kiss it. Maybe we'll do it tomorrow. But again, I know you hate technicals, but technicals matter when there's nothing else to watch. March feeders, we filled the downside gap from last week as well. There was a gap there, basically coming in at 333.20. We filled that today. The low today was 332.60, right? So we went down and filled that gap. Now the argument's still going to be, what about that gap, which extends all the way up till 345, the October 24th low? Well, that's basically $9 away. Are we going to get there between now and Christmas? A lot of cattlemen are hopeful that we do. And lean hogs, again, super, super, super technical correction. We had the sell-off, we had the rally. Now today we gave back 25% of the rally in one day. Hogs trade like they ice skate. I have a friend of mine, JD, down in Indiana. He likes to tell me that all the time. Hogs, they trade like they ice skate. One day they go this way, the next day they go that way. Very, very difficult. I will say this: if you look at April lean hogs. You know, the high of the move was 94 and change, almost 95. The low was 81. Why did we pause right at 89.55? Well, part of the reason was it was a 62% retracement. Also, a lot of people get attracted to round numbers. Everybody wanted to sell 90 cents. Round numbers attract a lot of business. So, can we still get there? I don't know. But at the end of the day, if I'm long hogs, I want to make sure that I'm doing something because, again, last time I checked, 88 cents is a lot better than 81 cents. And we were just there, 6 or 7 days ago. So, use the rally. I know this time of the year, there's not a whole lot of people want to do a whole lot, but I think there's going to be one or two opportunities every day of the trading week as we try and figure out where this market's going to go next. And if you're looking for help, give me a call, 312-638-8868. I send out a letter every day. I do a weekly wrap every weekend. The weekly wrap is a 30,000-foot view of what's going on out there. It is very, very technical. It's the stuff I've learned. I spent 20 years trading my own money at the Chicago Board of Trade as a floor trader. I've been working with farmers and producers for the last 15 years. Um, I have not reinvented the wheel. I think I do a good job of staying on top of the technicals. I am not psychic. I do not have a crystal ball, but I do think I can help you make better cash sales, especially if you're struggling. If you're struggling with your market, sometimes it's just nice to have somebody to bounce ideas off of. That's a big part of what I can do for clients. I do not charge a bushel fee or an acre fee. You don't have to cut me a check just to talk to me. There's no consulting fee. I don't have account minimums. If you like my letter, it's $1 a day, basically $1.37 a day. It's a cup of coffee a day. If that's too spendy for you, then you probably have more problems than your grain market day, to tell you the truth. Um, I make recommendations. You guys choose the decisions. If you trade with me, I clear through RJ O'Brien. If you'd like to open an account and start working with me, give me a call, 312-638-8868. What else? Oh, yeah. I will be posting tonight or tomorrow my weekly private client, I guess you call it a podcast. Yeah. I'll go through about half dozen charts and I'll tell you exactly what I'm looking at, exactly why I'm looking at that. And it gives me a little bit more time. And some people like to watch that classroom environment rather than reading a letter. All right, guys, have a good rest of the day. Thanks for your time. Take care.